The Bank of England just hit pause, and it's not because everything is fine. The bank's Monetary Policy Committee voted to hold its benchmark interest rate at 3.75% at its latest meeting. That ends, at least for now, a cutting cycle that had been gaining momentum as UK inflation appeared to be coming under control. But the headline number tells only part of the story. The bank also warned that inflation is expected to rise again in the months ahead, and that warning changes the picture considerably. Here is the tension policymakers are sitting with. When an economy is fragile, central banks typically cut rates to make borrowing cheaper, encourage spending, and support growth. But when prices are rising, or about to rise, cutting rates carries real risk. Cheaper borrowing can pour fuel on inflation, pushing prices even higher. The Bank of England is caught squarely between those two pressures right now. UK inflation has had a rough few years. After surging to multi-decade highs, it had been slowly drifting back toward the bank's 2% target. A fresh uptick, if it materializes, would push back the timeline for further rate cuts. That matters enormously for households already stretched by years of elevated prices. Mortgage holders, renters, anyone carrying debt would feel the delay. The bank's language also carries weight beyond household budgets. When a major central bank signals it may keep rates higher for longer, what markets call a hawkish tilt, it tends to move asset prices across the board. Government bond yields can rise, the pound can shift. Broader sentiment in European and global markets can follow. Investors watch these signals closely because they help price everything from home loans to corporate borrowing costs. For now, the bank appears to be choosing patience. It is waiting to see whether the expected inflation pickup is a short-term blip or something more stubborn before deciding on its next move. That kind of deliberate caution is standard practice for central banks navigating genuine uncertainty, but it does mean rate relief is not coming soon for UK borrowers. Two things are worth watching as this plays out. First, the Bank of England's next set of inflation forecasts. Those will tell markets how seriously policymakers view the coming price pressures. Second, the vote split inside the Monetary Policy Committee. If more members shift toward holding rates firm rather than cutting, that is a clear signal the cutting cycle is on a longer pause than many had hoped. The bottom line, the bank sees inflation risk building, and it is not willing to cut rates into that headwind, at least not yet. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.